The world has gone mad and the system is broken. This is a direct and somewhat shocking quote from Ray Dalio, the founder of the world's largest hedge fund, a man who knows a thing or two about capitalism. So, why exactly would a man who has profited so greatly from capitalism believe that the system has become broken over time? Let's dig into it. But first, I'd like to announce October's winner from our monthly contest to win a free 30-minute video call with me. The winner is the YouTube user Prime Shift with this comment. I've just reached out on Telegram, so please check your messages ASAP. If you're watching this and you'd like to enter for November's free draw, all you have to do is the following steps. Number 1, like the video. Number 2, subscribe to the channel. And number 3, simply comment your Telegram username so I can reach out to you if you are this month's winner. Enter now before you forget to later on during the video. Right, let's get into it. Why exactly does Dalio have such a seemingly pessimistic view? His article begins by discussing globally low interest rates, even negative rates in certain countries. Dalio discusses why lenders are happy to lend money with such low rates. He believes this comes down to the enormous amount of money that they have to invest, this being a direct consequence of central banks printing money and buying up financial assets in their attempts to raise economic activity and inflation. So the question is, why isn't money printing, also known as quantitative easing, pushing up economic activity and inflation? Dalio believes that this is because investors who are getting money want to invest it rather than spend it. As a result, the price of financial assets is increasing while economic growth and inflation have remained sluggish. As the price of an investment rises, its future expected return drops. Let's say you have Company A with a share price of $100. Company A offers a $5 dividend at the end of the year to investors. This is a 5% return on your investment. As a consequence of quantitative easing, the share price of Company A has now increased to $200. However, because the economy has been sluggish, company profits remain the same and investors again receive a $5 dividend. Now, though, this $5 dividend represents just a 2.5% return on investment, or half of what you had previously achieved. This diminished return on investment holds true for bonds, equities, and nearly all investments out there. However, unlike bonds that offer investors a consistent return, and this number is decided up front, other investments offer variable returns. Put another way, nobody knows what the future returns of a stock will be. As a result, the expected return is created in the imagination of investors. Because many investors have witnessed incredible success stories of tech companies in years gone by, their imaginations often run wild. This, combined with the excess cash held by many investors, has led to these investors virtually throwing cash at companies. Today, there are more companies than at any other time since the dot-com bubble that don't have to even make profits to achieve extremely high valuations. In fact, many highly valued companies today do not even have a viable path to profitability that they can implement in the future. So far, this sounds extremely familiar to many situations in history. A bubble. Money has been printed and borrowed with ease. Those with money are choosing to invest rather than spend, causing asset prices to rise significantly faster than the economy grows. Dalio has lived through several bubbles in the past, so why is he viewing today's situation with such concern? The answer is because of how he believes governments are going to act moving forwards. This can be seen where he discusses government deficits. The majority of countries globally have large deficits, i.e., they've borrowed money in order to spend more than they have earned. Or, as you and me would say, most governments are in debt. Dalio believes that these government deficits, or government debts, will continue to grow substantially. Therefore, governments must sell huge amounts of extra debt. Usually, the purchasing of this debt will drive up higher interest rates. But Governments today cannot afford to have higher interest rates, with the markets already looking dangerously overgrown. As a result, the money to buy this extra government debt will almost certainly come from central banks printing more money. Dalio says this whole dynamic in which sound finance is being thrown out of the window will continue and probably accelerate, especially in the reserve countries and their currencies, i.e., in the US and the US dollar, Europe and the euro, and Japan and the yen. In other words, Dalio believes that the reserve currencies of the world are being actively undermined as stores of value by their own governments. For the general economy, this is likely to be a serious problem. For all of you fans of alternative stores of value out there, such as gold, silver, and Bitcoin for many in this community, these words may not carry such a negative note for your ears. Dalio then goes on to discuss his final and equally considerable concern in the US: pension and healthcare payments. Simply put, a time is coming where those who are due to pay for pensions and healthcare won't have enough money to meet their obligations. So, what happens next? Will people simply not receive healthcare or the pensions that they were promised upon retirement? While examples of this may occur, the government certainly cannot allow this to become the norm. Instead, governments will have to attempt to bridge the gap between the money held and the money owed. And how exactly are they going to do this? Dalio describes three possible routes. Number one, cutting pension and healthcare payments. Number two, raising taxes. And number three, printing money. While none of these options are ideal, printing money is the easiest path, the most hidden, and the least objectable for the average person. Watching this video, you may have noticed the common theme here. Governments are likely to use money printing or quantitative easing to address many different economic concerns. But what is the problem with this? The printing of money tends to have one consistent outcome: increasing the price of assets. But this sounds like a positive, right? Not quite. In general, the rich tend to buy assets, while regular people often take on debt. Therefore, with asset prices rising, the rich get considerably richer, while the average person remains pretty much stationary. In other words, the wealth gap between the rich and the poor grows ever greater. Dalio goes on to say the system of making capitalism work well for the people is broken. This set of circumstances is unsustainable and certainly can no longer be pushed as it has been pushed since 2008. That is why I believe that the world is approaching a big paradigm shift. This all sounds pretty doom and gloom. I'd love to put a positive spin on things for you, but I believe it's best in these situations to be honest with yourself and research as thoroughly as possible how you can protect yourself if Dalio is correct and this future does play out like he believes. If you'd like to begin this research, check out the video in the top right, where I discuss in greater detail Dalio's thoughts on investing into stores of value. If you've enjoyed this video, please remember to give it a like, as it takes a considerable amount of effort to put together. And if you've made it this far in the video, that means you've obviously enjoyed something about it, and you're probably going to want to see more content just like this. So make sure to subscribe and turn on notifications. That way you can enjoy being part of our incredible community.